very much like to move on to what I called the microeconomic crisis, which is effectively how the financial system, this is my summary of it, is how the financial system has worked or not worked over the course of the last decade. Our expectation is, in a capitalist economy, that institutions with failed business models should be allowed to fail. It's very clearly we, for reasons that are understandable, if not right, for understandable reasons, have not let failed business models fail. And so the question is, what is left of our capitalism? Is there something right at the heart of it, a particularly well-remunerated section, that is, if you like, somehow not obeying the rules of capitalism, whereas everyone else is? So it's capitalism for the poor, if you like, and socialism for the rich. So Martin, I'd very much like to get your reflections on this and hear whether you're still in the sort of city grandee who defends it, or whether you yourself see that something's gone awry.
Well, I tell you, I hope this is not going to appear too theoretical, but it would be much better from the banking point of view if banks could fail, because then you'd put your money, this whole audience, would put your money with banks which were well managed, and those banks would pay less interest on those deposits than banks which were rashly managed. But that's absolutely theory and is not going to happen, because governments need votes, and they need the votes of people who've deposited their money with failing banks like Northern Rock. So the banks are now effectively guaranteed by the government when they're too big to fail. And that's a problem, because that means that you then have to rely on regulation rather than market discipline to try and manage banks properly. And as soon as you rely on regulation, then everybody running a bank will behave up to the limits of regulation rather than commercial prudence, banking commercial prudence. And you know your competitors are going to do that, so you're tempted to do it like that yourselves. And the big problem, and I'm just going to stop in one moment, the big problem that we had in the run-up to 2007 was that the regulators did an incredibly bad job. They allowed banks to treat as AAA assets stuff which was nowhere near AAA assets. So that when you blame banks, as I expect many of you do, pay attention to the other people who you should blame, which are the regulators, the rating agencies, the accountants, and, of course, primarily governments who allowed this to happen.
But you're not advocating in capitalism the whole system has to hinge on having better regulators than
yes.
Howard Davis and Adair Turner and Mervyn King, and I mean, you know, these were the people who were running the show.
I hope you're not going to ask me to comment on any of those names.
No, but you're saying the system actually, that the whole thing hinges on finding a better set of regulators next time. That seems like a very tall order.
No, I think it certainly does depend on having good regulators. There's no question about that. But I think there are also market disciplines which you can try and reintroduce, which would improve the situation. It is significant that the banks which were owned by which were managed by the people who own them, of which there are a few left, did not get into trouble.
Diane, I know you wanted to.
Sorry?
Diane. Regulation is certainly not the answer. I think there's a clue about too big to fail in the too big part of that. And we'd had 2 generations of banks merging with each other and becoming bigger and bigger. No successful new entrants into banking for current accounts and mortgages and so forth. There's a more modern, more advanced banking system in Kenya now than there is in the UK, because the mobile phone companies have entered with financial transactions by mobile. And in this country, you can't get into the market for current accounts and mortgages. You can't get into the payment system. There's an absence of competition. And the banking monopoly, the banking bonuses come from the fact there are monopoly profits in banking. There's no pressure on banks to serve their customers properly, to give them better rates, to innovate in ways that help customers rather than their own ability to make profits and pay themselves bonuses. So I think it's not regulation, but an absolute absence of competition and the development of these powerful oligopolies that influence the political process.
Linda, you work on Bloomberg Television, which covers the financial sector. more than, one of two, but essentially 24-hour, round-the-clock, covers the financial sector. Do you ever think, God, this is all so appalling. This whole thing is not working. Do you ever have that, here I am, I'm giving a sort of minute-by-minute market commentary, economic, every piece of data poured over, which is just a sort of a random noise over which some of our best brains are trying to see patterns. Do you never, as one of those best brains, stand back and think, isn't there something I can do?
I feel really motivated to go in tomorrow. I agree with what Diane has just said. I find it just quite astounding sometimes, the degree to which we're still trying to sort out the mess from a few years ago. And when you look at the bonus culture, which is still there, really not much seems to have changed. As an economist, I'm a strong believer in incentives, and I think there's certainly a deeper look, not the minute-by-minute movement of the market, but a deeper look at how it is that we have structured the banking system and the role that it plays in the society. And the incentives are obviously set out by government, by regulators, but also it's the responsibility of the bankers themselves. So I've always been a huge, I'm a lawyer as well by training. I used to be a corporate lawyer, and lawyers have this great phrase where we don't believe that regulators can set up anything properly in the first place, and all laws come about through what's called the crash then law hypothesis. So you have to have some type of collapse in the market or some type of issue, and then you have the stakeholders to re-examine what has happened, and then you try and formulate the next step.
You shut the stable door.
Yeah, exactly. And then the criticism is that it was formulated for the last crisis, but it does keep the lawyers employed for the meanwhile. But I think my bigger point is that I think this crisis has raised questions about what is the role of banks in a society, and I think we're having the right kinds of discussions about it. And I don't think we're going to come up with a perfect solution, because the lawyer in me always thinks there's work to be done for lawyers.
Take Anatole and then Thomas.
Finally, we've got some real disagreement, because I disagree with everything that everybody has said on this panel. Because I think what we're missing, this is my strong view, is that we're missing the essence of this, which is that actually it is the market that has failed, and it's not a particular market that's failed, it's the whole philosophy of relying on the market that has failed. This is not about regulators not being clever enough. You know, how Davis and Mervyn King, at least as clever, certainly harder working than governors of the Bank of England used to be. You know, people like Robin Lee Pemberton, who used to leave on Friday afternoon to go shooting. It's not that they're not clever enough, but it's that they felt, until a few years ago, that it was the job of regulators to follow the market, to look at market signals, and to believe that the market knows best. Now, of course, if you have a regulator who says the market knows best and you can't buck the market, he's not doing the job. Similarly, it's not about competition. There's plenty of competition in investment banking, which is where all the real money is made. The fact that there's no competition between clearing banks has nothing to do with the high pay of bankers, nor is it about private ownership. Lehman was a privately owned bank. Dick Fuld owned 30% of the shares of Lehman. He lost $2 billion overnight. It didn't affect his management of it, and nor is it about too big to fail. Northern Rock was not too big to fail. Every bank is too big to fail in modern society, because none of you are willing to put £1,000 in the bank and lose any of it. Quite rightly, in a modern society, we assume that banks are safe. So all these market solutions are not going to work. There's got to be a recognition that there are certain parts of economic activity where the market should not rule. They should be ruled by political and administrative decision-making.
Right. Thomas.
Yep, that's exactly right. Hear, hear. So, I came over here from America, which over the last 15 years has just become this sort of panorama of epic corporate fraud, right? You go back and look at from the Enron debacle up to the housing bubble. It's just one damn thing after another. and you think of all the different, we were talking about banking prudence and market discipline. Just think about the incredible ways that discipline has fallen apart. Think about, all the conflicts of interest at Enron. Do you guys remember Enron? You know about this, right? Where these people, the accountants were basically signing off on these just staggering conflicts of interest. Why? Because the incentives told them to do it. Because that's the way the incentives wanted everything to go. That's the way the market wanted it. You look at the sort of the scandals of the corporate boards who are approving these lavish paydays, these unbelievable paydays for CEOs that are driving companies into the ground, or for all the bonuses for these traders, selling the poisoned bonds back and forth to one another. You look at remember the scandal with the Wall Street stock pickers? Not the stock pickers. Do you remember that there was a guy in New York who deliberately changed his rating on a stock in order to get his kid into a fancy preschool? Do you remember this? There's a big scandal in 2001, 2002, when and then of course you have the very similar scandal of the bond rating agencies. You were referring to this a second ago, rating these sort of, mortgage-backed securities, which everyone knew were shit, right? And rating them AAA, gold-plated, right? This wasn't the government that did this. This was the private bond rating agencies in America. Or you think of the professional economists that just sat on their hands and watched all this. Now, this is the failure of, market incentives, okay? But you look at the failure of the regulators, which is equally pronounced. This is an amazing story, and this is something I know a great deal about because my last book was about regulatory failure, The Wrecking Crew, it was called. It came out in 2008, but I'll just give you one anecdote from the days of the Bush administration, when there are 5 different regulators for banks in America, 5 different agencies, and they were just systematically subverted. Okay, defunded. You look at the Securities and Exchange Commission, where basically these guys, these lawyers in Washington, paid on government salaries, they're going up against the most, fantastically paid lawyers in the world, Wall Street lawyers. These guys in the Securities Exchange Commission have to make their own photocopies. Right? Because they don't have secretaries, because they work for the government. And of course their photocopiers are broken, right? So they're down there waiting in line at Kinko's to make their photocopiers. But the story that's the best, there's one of the 5 regulators is called the Office of Thrift Supervision. And these people, do you know about these people? They just happen to be the regulator that was supposed to be overseeing, I'm going to get it wrong, but some of the biggest bank failures in U.S. history, Washington Mutual, IndyMac, okay? These guys were... sort of what they would do in America over the course of the last 30 years is you fill these regulatory agencies with lobbyists from the industry that's regulated. And this was done deliberately. And there's all sorts of theories for why you should do it this way, and market discipline, and listen to the markets, and blah, blah, blah. Market-based government. But the guy that they had at this particular regulatory agency, it sort of symbolizes the whole Bush-era approach to regulation. He had this photo opportunity where he was posing with a bunch of lobbyists from the banking industry. These are the guys, the industry he's supposed to be overseeing, remember. And the title for the photo, the big backdrop that they're standing in front of, says "Cutting Red Tape." And they've all brought garden implements to show how committed they are to cutting red tape. This is the regulator, right? Meeting with the lobbyists, and the regulator has brought a chainsaw, right? That's what happened, and it happened that way because we put people like that, not we, because the people running the American government put people like that in office deliberately, okay? They sabotaged the system on purpose.
Thomas,
okay, I'm shutting up now. Sorry about that.
Very, very interesting, very interesting. I wanted to slightly, I'll let John come in, but I want to just slightly redirect this, because there's the sort of specifics of banking and regulation. But someone in the city said to me something, he said, basically the best brains in the city apply their minds to arbitraging the value out of institutions, structures, deals, corporations, and transferring it to themselves, rather than creating value in those institutions. And we have seen, take a very good example, private equity, which essentially went into companies, a lot of companies, took them over, very brainy people, loaded them with debt, sold them at the height of a boom, and then the companies were left more or less wrecked. And the question was, those people, we wasted an awful lot of very clever people in an activity which is essentially grabbing rather than creating. Warren Buffett puts it very well. He said, well, if we did all land on a desert island, we wouldn't really have the 10 cleverest people among the 100 of us trading futures in the crop that the other 90 were trying to grow. We would actually ask the 10 to be thinking about how the hell to grow more. And John, I just wonder, just getting beyond the banks, the whole role of financial capitalism.
Yeah, I mean, I think that's the key issue, Evan. And let's come back to it, if we may, after understanding what is going on in the banks. Actually, we know the answer to the banking problem. In Britain, we did not have a banking failure of any significance in the course of the 20th century. Why didn't we have a banking failure in the course of the 20th century? It's because we had a relatively small number of conservatively run, boring banks. What they did was they took in deposits and they lent some of what they took in out mainly to people who didn't very much need it. And we had building societies which collected people's savings and they lent them out to house buyers who would be willing to pay the money back, otherwise they'd be put out of their houses. And that system worked perfectly well. And the reason it stopped working at the end of the century was we allowed these institutions to turn themselves into financial conglomerates which used the security of the deposits and savings of everyone in this room as collateral for speculative trading. Let me tell you what British banks do. The total balance sheets of British banks are between 6 and 7 trillion pounds. The amounts of money that are so large you can't imagine it. About a quarter of that consists of residential mortgages, of the boring loans you and I take out to buy our houses. And that's by far the biggest thing that banks do for the real economy. Banking is basically the boring business of taking in our savings and helping us buy our houses. There's a tiny amount, which is the amount which is really important and we should all be really concerned about, which is lending to non-financial businesses. But that's a tiny part of what we're talking about here. It's about 200 billion of that 6 to 7 trillion. It's about 3% of the total. What's all the rest? The rest consists almost entirely of financial institutions trading with each other. Now, common sense suggests that people passing round the same bits of paper back and forwards to each other, they're not, in aggregate, adding any value to that process. And you might ask what is wrong with that common sense, and I've been studying this for a long time, and no one has ever really managed to give me the answer. So what do we do? You began, Evan, by saying, well, the way capitalism works is when businesses fail, we shut them down. And that's right. Now, when these businesses failed in 2008, we couldn't shut them down because we'd have been shutting down, as you explained, not just this merry-go-round of people lending money back and forwards to each other, but we'd have been shutting down the institutions that look after our payments and our savings and so on. But what we should be doing is an orderly winding down of this particular process. We ought to go back to boring banks that take money in and lend some of it out. Build mortgage banks that collect our savings and lend it out to people on sound mortgages. Now, I don't want to stop people lending money back and forwards to each other if it amuses them. I don't think it's going to be a very profitable business in the long run. In fact, I'm pretty sure it's not going to be a very profitable business in the long run if they can't divert the profits from boring banking activities into their own profits. But they should use their own money for it, and in due course it will wind itself down. And that's actually the market operating in the way it should do, and that's what we should be trying to achieve.
Okay, thank you. We'll open up to the floor. I'm just going to ask Stephen to make a comment, because he works for a bank. He's not a banker in any normal sense of the word. He's an economist. He could be working for a ratings agency, for example. Or a university department.
You're trying to make me sound very popular, aren't you?
Your bank is actually the one that has probably the least question marks over it of virtually any in the world over the last decade.
Well, you're very kind. I can't speak for the bank itself, but I will make a couple of observations. The first is that I am just an economist at HSBC, and that proves that my brain can't be very big, because you've been talking about these people doing trading and futures and so on. They have the very big brains. I don't really understand what they're doing. But secondly, I just wanted to make a comment.
Not they. That's the problem.
Yeah, that's possibly the case. I don't ask. But I think one thing I'd like to add on this, going back to John's comments about these nice, cosy banks in the past, is that back in the 50s and 60s, there was very little competition in banking. It was a nice, cosy arrangement. But for many people who perhaps wanted to buy a house, they couldn't do so very easily because they had to get in a queue for mortgages. And by queuing, they had to wait for a number of months before their mortgage was approved. We moved completely in the opposite direction over the course of the last few years, where virtually anyone could get hold of a mortgage, partly because of the massive increase in competition. The competition wasn't just associated with what was going on within individual countries. It was a move towards a much more globally competitive capital market. I mean, one of the biggest revolutions over the last 2 or 3 decades has been this extraordinary increase in cross-border capital flows, which makes it so much more difficult to regulate capital markets than might have been the case in the past. And so the difficulties that came through over the course of the last few years, particularly in the UK, were not just associated with the UK banks themselves, but also the arrival in the UK of Icelandic banks, Irish banks, a whole range of other banks, which increased competition, reduced the profitability of each individual bank, and frankly encouraged banks to take far too much risk, because they had to take the risk to try and reward their shareholders, who were frustrated with the low rates of return. Now, we could go back to a world of capital controls, of restrictions on cross-border activity. We could go back to the 50s and 60s, and many people say that's great, because that was a period of strong growth, with relatively low unemployment, relatively low inflation. All those things were wonderful. But at the same time, we should also remember that the opening up of capital flows around the world has been extraordinarily important, not so much in the States or in Europe, but in opening up opportunities for countries which have been stuck in poverty for hundreds and hundreds of years. I'm thinking here of China, India, parts of Latin America, all of whom have frankly been the biggest beneficiaries of the opening up of global capital markets over the course of the last few years. So I think sometimes there's a kind of parochial focus on what's going on in the UK or the US, which is entirely understandable. But sometimes we need to realize what the choices are if we move away from this free flow of capital across borders towards something which is much more regulated.
Sorry, Stephen, we're not lending to China. China is lending to us. It's very hard to believe, but the global capital flows, the global imbalances that people talk about, consist of the savings of Chinese peasants financing the excess consumption of people in Britain and the United States.
Well, that's
probably the most bizarre development imaginable
that's
in
not
the
quite
world.
true. I think the way it works is that effectively the Chinese effectively deposit money into the US or the UK. US and UK companies who have the money then reinvest back into China. So effectively, a lot of the Chinese growth has come as a consequence of Western companies investing in China. I think that's something which has been pretty important in recent years.
I want to open this up to the floor. I want to get some of your comments. We've got a gentleman here, and we've got, if we've got one upstairs, yes, we'll take one upstairs, and we'll take one over there. But we'll start, if this gentleman has the mic. Yes, go ahead.
taking up the theme of John Kay about the dangers of the banking system passing pieces of paper to each other and the proportion of their activities that represents, many people would say that was enabled by the repeal of the Glass-Steagall Act, which happened, I think, during the Clinton administration. The Glass-Steagall, which had been put in place, I think, after the terrible depression of the 1929-1930 time, to protect against the sort of dangers which culminated in 2008. So my question would be, is it really possible for that winding down which John Kay was hoping would take place, unless there is something really like Glass-Steagall put back in place and which has more teeth than it seems the Vickers recommendations would lead us to expect?
Thank you for that. Who on the panel wants to contribute to that? Okay, Thomas, give us a very, very brief.
Talking about an American
very
law.
Quick.
This is the Glass-Steagall Act is in the United States. This, I bet you knew that.
We did. Most of us have now heard of Glass-Steagall, which separated the banks.
Yeah, it separated investment banking and commercial banking, and there was a. And yeah, it does have some. It has some role in. I mean, it allowed too big to fail, basically. Although the term "too big to fail" came about, was invented before they repealed Glass-Steagall. And this is. I mean, it's a very long story, and I'm not going to bore you with the whole thing. But there was there were a lot of people talking about bringing back some version of it. Most notably, Paul Volcker, who was a former chairman of the Federal Reserve Board in the United States, and there's not a whole lot of political will to do something like that. And this is the really depressing part.
We're doing something here, though. I mean, John, is it remotely addressing the issue that you...
It is. Thomas is, of course, right that Glass-Steagall was a piece of American legislation. But in the United Kingdom, we had an effective Glass-Steagall provision until really two groups of changes. One came in the early 1970s from a policy known as competition and credit control, and the other, more important, was the group of issues round about Big Bang in the mid-1980s. And what was happening in the same period in the United States is Glass-Steagall was being steadily eroded until it was finally repealed in 1999. And it was essentially the transformation of a financial services industry in which commercial banks did the kind of things that traditional commercial banks did. Building societies did what building societies did. Insurance companies did what insurance companies did. Market makers and stockbrokers did what they did, and so on. There were silos of different businesses in different areas, and all these demarcations were swept away. And we got the emergence of these wide-ranging, uncontrollable, poorly managed financial conglomerates. In retrospect, it was a mistake, and those in the audience who say we should reverse that mistake are absolutely right and getting to the essence of the matter.
Gideon, did you want to come in there? No, we're going to talk about the euro in a minute. Yeah, come up there.
Hello, thanks. I just wanted to make a quick point and then ask a quick question of the panel. The point is, whether it's John Kay, whether it's Anatoly Galetsky, whether it's our American friend, I can't remember your name, I'm sorry, and my eyesight is too poor to read the thing in front of you. What we're looking at fundamentally, it seems to me, is a failure of culture. That is my point. And my question is, which we'll begin to touch on in the second part of that microeconomic discussion, is to do with protectionism. My limited understanding of economic history is that previous periods of globalization have been followed by periods of protectionism, and I'm wondering if we are entering a new phase of protectionism.
But I actually really like the point you made, the first part, because I think if you look at a whole lot of industries, you could look at the newspaper industry now, and you could listen to Leveson Inquiry interviewing newspaper editors, and you just think, actually, there was no regulatory system you could have imposed that would stop this, or actually we had a regulatory system that was designed to stop this, but there was a culture of everybody just pushing a little bit too aggressively up to a kind of line that they thought they had. I do want to just ask the panel, I mean, Anatol, do you think there's any hope for saying, actually we can improve our capitalism by just making people somewhat better? and more restrained, a little bit more moral, a little bit less kind of quick buck, earn here, buccaneering. It's a very...
Well, better, no, but less oriented towards earning a quick buck, absolutely yes. But I don't think this is a question. I think you're absolutely right. It's about culture. It's not about virtue. And the point about the culture is that we went through, and this is basically what my book was about, that from 1980 onwards, we went through 20 years in which we were told that there is this supernatural force above all our lives, above all our judgments, above all our moral instincts, which is the market. And if the market does something, it must be right. If the market decides that a banker deserves to be paid $500 million a year, or a hedge fund manager, which they do earn, some of them do earn that, then that is appropriate. It's fair and just. And, even in our industry, James Murdoch, gave this very famous speech about 4 years ago at the Edinburgh Festival, in which he said, the only guarantee of sound journalistic ethics is the market, is the profit motive. I mean, that was basically what his speech was about. So if you believe that everything ultimately has to be ruled by the market and the profit motive, you can't have regulation, you can't have self-regulation and responsibility either.
Well, I mean, I think we should remember that there was a reason why there was such a surge of confidence in the market. It's that we've just seen the catastrophic failure of an entire system built on bucking the market, which was the Soviet Union and the Soviet Empire. So I don't think we should go too far in the other direction.
Yeah. Anyone else want to give a quick... Mr. Martin.
I'd just like to... Just going back to something John said. In the last century, we did have bank failures. I think he's forgotten about the secondary banking crisis in the 1970s. And what happened in those days was... and indeed before, was that when a bank became too weak and looked like being unable to repay its deposits, it was taken over by another stronger bank, which is why we ended up with so few banks. And of course, Diana is absolutely right that more competition, would be a very, very good thing. But all these, the rather glib, at least to me it's rather glib, case for reverting to the Glass-Steagall Act is based on a misapprehension of what was going on in the United States at the time it was introduced and what could happen now. And with modern technology and modern means of communication, it would be completely impossible and unnecessary to go back to the Glass-Steagall Act. But the Vickers Commission, which is a very sensible report they came out with, I disagree with parts of it, of course, as I would, but basically it's going in the right direction to try and make banking, regulated imperfectly as it is, a little bit safer.
Right, we've got time for one more question over there, at the back there. Yep. It's gone? Okay. Have we got another question on this whole issue? We've got a gentleman over there. Let's let him have the last word on this. And then we'll move on to the Eurozone, which is the easy one.
Yeah, hi. Why were there no conditions attached to the loans that the bailed-out banks received? Because it seems to me that everyone complains that RBS's share price has gone down, that RBS isn't profitable, and yet they're still paying out bonuses and there's still lavish corporate entertainment. My question is, it seems like you're trying to close the stable door after the horse has bolted. Shouldn't have conditions been attached when the loans were actually given to these banks, rather than trying to apply them afterwards?
We attached one very important condition, which was that we own 83% of it in return for the investment that we made, which obviously would allow us to do whatever we want, more or less, if we chose to exercise it. So interestingly, the question is why we do not choose to run RBS in a completely different way, I think I'm slightly rephrasing your question, but we do own it and we can do what we want with it. It's our bank. Linda, would you run it very differently, or would you keep it at this sort of arm's length?
I can understand why the government wants to run at arm's length, because they're worried about going too far, kind of Gideon's point from a moment ago, that we seem to reject the way the market works. So we all seem to admire countries like China. That somehow, if you have a state-run banking system, it would be better. But I think, that being said, I think given where the economy currently is, there's a very strong argument for using banks, which are essentially state-owned, to inject more credit into the economy and not to worry so much about running it on a commercial basis through this period.
I mean, it does seem remarkable. We want banks to do something, and
we own
83% of a very big one, which has branches all over the country, and we don't go out and make it happen.
Yeah, exactly. So I have quite a lot. I do think that is, a good point to be made. Can I just finish very quickly on a point on China, just because I think we kind of feel like we're all going to move into a Chinese state-led model. I've looked at China for a number of years, and actually one of the extraordinary things about those who study China is that they often think that China works because the market developed in spite of the government. But the advantage, I think, of China is that it has managed to build up institutions while injecting incentives for the market. It did it very, very slowly. So when something goes wrong, they can pull back and not do it. And I think in that way, it's allowed it to transition for 30 years at a very good pace. But I would just hasten to warn, we ought not draw too many lessons because China is such an unusual country. And I know that we tend to admire its current growth rate, but just on very quickly on the banks, one of the biggest worries about for the Chinese is the state of their banks. So
we don't know how the story ends, basically.
Exactly.
So let's not judge. Last word on this to Diane.
It's easier to let things run at arm's length if you set up the system the right way in the first place. And the banks have got bonus schemes that reward people for how they manipulate the share price over time, which encourages them to take risks, which seems a very bad thing to encourage bankers to do. And if we had a system where bonuses depended on the things that we'd like them to do, like lend money to businesses profitably over time, get high customer satisfaction scores and not missell products to their customers, then that would be a better scheme and they could run it themselves.
Right. We're going to move on to the euro. Before we do, let's just take a vote. How many people here, the vote is this, don't put your hands up yet. How many people here think the attack on bankers is overdone? That's going to be yes. And how many people think the attack on bankers is not overdone? No. So anti-banker, no. Pro-banker, yes. Okay. How many of you think the attack on bankers is overdone? And how many of you think it is not overdone? What do you reckon? 60-40 against the banks? Yeah, about 60-40 against the bank. Thank you.